I'm happy to be here in Boca Raton with my newest guest. I'm absolutely honored and thrilled to have with us today Richard Werner. He is a member of Linacre College at the University of Oxford, and he's also a university professor in banking and finance. I'm going to let him get into his CV because it's gigantic. The abridged version of his education is that he holds a degree from the London School of Economics and a doctorate from Oxford. Where he intersected with destiny, once he gives us his CV, that's where I want to start. I want to start on the ground in Tokyo in the summer of 1989, where you were poised to witness history as we know it. But first, tell us a little bit more about where you teach.
I teach in England at the Montfort University in Leicester, and also I've been asked to teach in Shanghai at Fudan University. I have also a number of more short-term invitations to a number of universities. And of course, I'm also very much interested in financial markets. I'm an UK regulated asset manager. I've run global macro funds, including for Bear Stearns Asset Management. I'm, for the last few years, essentially, my hobby has been to set up community banks in the UK.
We will talk more about that because you do have another book out there that is not Princess of the Yen, where you explore deeply what happened in the United Kingdom with its property markets, with its banking system. And we'll get to that because I think there are probably many parallels to be drawn. But first, let's take a walk back in time. You hear the anecdotes, Pebble Beach and all of the trophy properties and the massive outflow of money that left Tokyo, and the Imperial Palace was worth as much as the state of California. You hear these things, but it's impossible to put them in your mind if you weren't there, but you were there. What was it like? You were there before the bubble burst. And what took you there?
That's true. Well, what took me there was that I couldn't go to China, to Shanghai, to Fudan University, because I had a place there to learn Chinese. It was a bit ahead of things at the time, because it was still, the Iron Curtain hadn't fallen. But I thought China's going to rise and I want to learn Chinese. But it wasn't possible suddenly in '89 for various reasons. If you go back, martial law declared and things like that. I went to Tokyo initially for Deutsche Bank, and that was in the summer of 1989, at the peak of the Japanese legendary gigantic stock market bubble. Saw that at close range. In the end, just so you see where this was then leading, I ended up staying in Japan for quite a while, in total 12 years. Various doors open. I was at the University of Tokyo. I was the first Shimomura Fellow at the Japan Development Bank, one of the government banks that had been involved in the high growth era in Japan, establishing post-war recovery and very high growth for several decades. And then I was at the Bank of Japan. That's why I had my introduction into central banking. What was it like in '89? Well, one important feature is, if you think back, nobody called it a bubble at the time. It wasn't considered a bubble. It was just, that's the situation. That's the level of stock prices and land prices. It's Japan. And remember the stories, how Japan was going to take over the world, and it's going to be the next 21st century is going to be the Japanese century. Japanese money had been flooding out of the country across the world in the 1980s. And of course, people tend to extrapolate from these past trends, and then it was just all the way up for Japan. But that was clearly not going to happen. And I just come back from Japan in '91. The stock market had fallen quite a bit, down by almost by over 20%, 30%, approaching 50%. So big falls. But the economy was still expanding. GDP growth was 7%, 7%. Interest rates were around 7% as well. Short rates, long rates. And so what was everyone saying? Well, the Bank of Japan came out in 91 and was saying, okay, we're going to lower interest rates. And so for everyone, just based on the standard analysis, all the strategies were coming out and we're saying, well, buy Japanese stocks because, well, the economy is clearly strong. We know Japan's strong, good fundamentals, companies are strong. The stock market has fallen so much, and now they're lowering rates. And of course, the traditional standard analysis, conventional analysis is if you've got lower interest rates, that's good for the economy, it's good for stock markets. That's what they're doing. And they had a long way to lower them, which they did follow. Now, that's the moment my first paper was published back at Oxford when I just come back in September, October 91. And my conclusion was the opposite. Namely, and also remember, at the time, the top 20 banks in the world were all Japanese banks by assets, these huge balance sheets. And my conclusion was, don't buy Japanese stocks. Japanese banks are likely to go bankrupt, and Japan is likely to move into the biggest recession since the Great Depression. That was sort of written up in The Economist. I had the job offers, went back to Tokyo then in 93, started as chief economist, early 94, with the British firm Jardine Fleming Securities, since it's been bought up by JP Morgan. And my thesis was that essentially what has created the bubble was switching into reverse and was going to crush the banking system. But for a long time, people thought this can't be true, it's impossible. And I was really amazed by how long people hung on to the old story of the great Japan and the economy is going to be strong. It's just a small dip, and the fundamentals are so strong. To me, it was quite obvious. And I guess we should talk about the mechanism I saw behind this, because that really taught me about how economies everywhere work. It's the banking system and how central banks really interact there with the banking system, and how the credit mechanism in the banking system is the core mechanism. And all that was all contracting. I put out an estimate in the early 90s of the size of the bad debts I was expecting in the banking system. Now, in those days, people had tiny forecasts of bad debts. It wasn't really a topic, bad debts in the banking system. And my forecast was, well, it's going to be in percentages around 25% of bank balance sheets.
Wow.
Which also made it, approximately similar percentage of GDP, 1 year's annual GDP. So substantial, because we know capital is usually 10% or less, for the bigger banks, less than 10%. So certainly anything above 10% in bad debts is the end of the banking system, really.
That's insolvency.
Exactly. Now, ironically, by the end of the decade of the 1990s, everyone had become so negative on Japan. They had bad debt estimates which were much larger than my original ones from the early 90s. And then I was told, this is wildly too large. But by the end, the consensus had become so negative. But if you go back and actually check the figures, my original figures were the correct ones. It was around 80 trillion yen in bad debts, and not more, not less. How could I calculate this? Very easy, very simple calculation. And it goes back to the mechanism that created the bubble, and that was going to now create this bust and long recession, which is really the mechanism at the core of all economies. It's the money creation mechanism. Where does money come from? Mm-hmm. And it's funny, because when you study economics, as I've done, in any discipline, whether it's chemistry or physics or whatever, you study it at the top universities, you expect to become an expert in the important stuff in your discipline. But when you study economics, they don't really teach you about the money creation process and the monetary mechanism, because the leading economic theories and models, as you know, the highbrow ones, they don't even have any money whatsoever in their model. It's an abstracted theoretical economy where essentially people exchange things via barter. That's what they assume, because money doesn't matter. So we might as well take it out of the equation. It just confuses things. I mean, there's the famous book by David Romer. In fact, I did a survey. What's in the UK at British universities, what is the most widely used master's level macroeconomics textbook? And it was David Romer. It's his key book on macroeconomics and growth. And then on page 3, it says, essentially for more than half in the book, the models and theories don't include money because this would only confuse matters. So that was the state of affairs.
We heard from Jay Powell just a few days ago that it was no longer an appropriate part. It was no longer an appropriate mechanism for central banks to look at the money supply. And that is the orthodoxy.
Yeah. Yes, indeed. But really, it's surprising that he says this now at this late stage, because certainly since 2008, a lot of people have realized that, we neglected the monetary mechanism, and really we can't just exclude money. We have to understand how it works and where money comes from. And that was also my original puzzle when I was Shimomura Fellow in Tokyo in 1991, and I had this task to my research topic, on the basis of which I became the first Shimomura Fellow, was to figure out Japanese capital flows that were buying up the world, as you started out mentioning, Japanese money buying Pebbles Beach golf course, Rockefeller Center, Columbia Pictures, whatever, in Australia, in Hawaii, and in the UK. They were buying up companies, real estate, whatever, you name it. And it was just so much money that no standard economic model could explain it. All the world's experts were saying, we don't know, there is no answer. Somebody told me, there's famous US economist, Jeffrey Sachs. He was recently in Tokyo at MITI, the Ministry of Industry and Trade, with his, I think, former PhD student Peter Boone, and they've written a paper on just this topic. Richard, you should go and speak to MITI. They will have the paper. And I went there, met various bureaucrats, and they told me, yes, Professor Sachs and Peter Boone, they were here. Oh, yes, we have their discussion paper, which they presented. And it was, because my fundamental idea was it's clearly linked to these crazy asset prices, land prices, where the Imperial Palace Garden had, as you said, the same value as the entire state of California, including Los Angeles, San Francisco, you name it. Crazy. And so that there had to be a link. But what precisely was the link? There was the paper, Jeffrey Sachs, Peter Boone. I was delighted because, I barely finished my first degree at the LSE. By the end of it, I was very disappointed to find there is no link. That was their conclusion. There is no link. Why? The argument was, well, okay, you've got totally overpriced Japanese real estate, to the extent that it makes sense for Japanese landowners to just sell a tiny plot of land and buy a few big chunks of California. Why not? Just for diversification purpose alone would make sense. And that would give you the mechanism. But they were arguing, well, hang on, even if you did that, which seems perfectly rational, this wouldn't affect capital outflows or the whole, monetary situation. Why? Because if you own the land and you want to cash in, you've got to sell it. And who's buying it? And foreigners were not buying Japanese land because it was outlandishly expensive. So it was only other Japanese who were buying the land. And therefore, it's just money moving from Japanese owner A to Japanese landowner B. And therefore, plus minus zero international impact. There shouldn't be any international impact, which was a logical argument. But Richard Koo at the time, he was known as a capital flow expert. And I told him about my job, my task. I need to find out, what is this link between the property market and capital flows, or otherwise what explains these capital flows? And he told me, look, Richard, forget it. You won't be able to solve this one. It's too complicated. Nobody has a model that works. But I didn't give up.
That was a challenge.
Yeah, it certainly was a challenge. I mean, all the experts were saying, there is no link. Doesn't, do something else. You won't be able to crack that nut. So, but the conclusion is that I did find out. It's a very simple insight, which at the same time answered so many other questions as well. It goes straight to this money creation process. And the answer is that no, the landowners that want to cash in and diversify and invest abroad, they don't need to sell their land. They just use it as collateral to borrow money from a bank. But now comes the next step. What happens when you borrow money from a bank? What happens then? All the leading finance journals and most textbooks will tell you, well, banks are financial intermediaries. They gather deposits. They do their analysis on credit, evaluation and credit rating, all sorts, and then they use some of those deposits and lend it out. So they're financial intermediaries. They're just in between the depositors and the final use of the money. But it's not true. But the conclusion is this is not actually what happens when a bank gives out a loan. Banks are not financial intermediaries. I could show this with data, but empirically, I proved this only much later. This was published only in 2014, where I did a separate empirical test. This is using German banking data, because really, this financial intermediation theory is only one of 3 theories of banking. And it's extraordinary. I mean, banking has been around for 5,000 years. You go back to ancient Babylonia, and there were essentially modern banks. There was a credit economy. There was interest being charged. There were collateralized loans, uncollateralized loans, cashless transactions. It was a proper banking system, because essentially banking is accounting, and they kept good records, and we have them in the British Museum. Thousands and thousands of clay tablets, right, in cuneiform, where they noted, and they're mostly accounting records and banking records. So banking is ancient, yet until recently, there's been a debate, still an ongoing debate, a controversial debate about how banks actually work. And there's these 3 theories of banking. Now, the one that I described is the dominant one, the conventional one that's in all the textbooks and finance journal of finance, and so on, journal of money, credit, and banking. They think banks are financial intermediaries. This is not based on empirical evidence, by the way. Now, there's a second theory, and that's the older one. And some people remember, because that used to be taught in the textbooks, also in economics, namely the fractional reserve theory of banking, which says that a bank always has to put a percentage of their deposits with the central bank, the fractional reserve, and let's say if it's 1%, the bank gets a new deposit of $100. It will put $1 with the central bank and lend out 99, but the 99 will then become some other bank's new deposit when you use it. And that bank will then put 1% aside, give it to the central bank as a reserve, and lend out 99% of that, 98 point, and so on. So the whole thing continues. That will then become some other bank's deposit. Each time the amount gets smaller, and it's a geometric progression, and mathematically, and you can calculate the total. And with a 1% reserve requirement, the 100 initial deposit become 10,000 in aggregate in total deposits. The central bank has 100 as their total reserves from all the banks, these small amounts, and total new lending in the banking system is 9,900. That's the fractional reserve theory. It's sort of slightly complicated, but sort of also, there's a certain logic to it. Now, that's not any more popular, as you may know, you may have noticed. Nowadays they don't talk about this. They talk only about this financial intermediation theory. Banks are like non-banks. There's no difference. Now, there's a third theory, and that one is the oldest. That one was popular from essentially, until roughly the 1920s, 1930s. That's when the fractional reserve theory started to become dominant. Until the 60s, then we had the financial intermediation theory. And this oldest theory is the credit creation theory of banking. Now, that's the most surprising one. And that one says banks are not financial intermediaries. They do not intermediate. They're actually creators of money. And when a bank gives out a loan, this is newly created money that's added to the money supply, but not like in the fractional reserve story in some kind of indirect collective fashion where you can't kind of grasp where's the money creation. Oh, it's just in the system, it happens in sequence. No, the credit creation theory says no, each individual bank creates new money when it gives out a new loan. So these three theories, they differ in terms of the question of when a bank lends money, where does the money come from? And so recently I thought, and obviously, I knew already in the early 90s the answer and used that in my work quite successfully also as economist and forecaster. We can come to that. But I also wanted to end this debate and the fact that even in this day and age, people still think banks are financial intermediaries. So I conducted a few years ago the first empirical test of this theory. I mean, that's the scientific thing to do, isn't it? There's three theories. They say different things. Well, what do we do? Well, we need an empirical test. Published 2014. If you Google, can banks individually create money out of nothing? You'll get it. It's the most downloaded, apparently, academic paper in all the Elsevier academic journals across all the various disciplines. So made a bit of a splash when it came out 2014. Even the central banks then came out, Bank of England. Oh yes, banks create money. We knew that. We knew that. Well, they knew that, but they didn't publicize it. So, but let me tell you. So this study was essentially going to a bank and saying, well, this has to be real. So I'm really going to borrow money. Because the three theories of banking differ on that point. When you borrow money, where does this money come from? So we're going to go to a bank, a really functioning bank. We need access to their accounting system, and their IT essentially is all in the IT, isn't it? We need access to that, which was a bit of a big hurdle because that's all high security, isn't it? Customer data and so on. But for scientific research, I managed to get that. The BBC was actually filming as well. And the question then is, so does the bank, when the bank gives out a loan, so I really borrowed money, it was 200,000 euros, which would be what, $250,000 or something. And I told the bankers, well, no, I want to transfer this away to my own bank account at another bank. It needs to be, I really need to get the money. Otherwise, I don't want some kind of simulation or theoretical stuff. It has to be real. So they were quite nervous about this. Like, is this quite an elaborate scam? And this guy is just going to run with this money. And so we did this. And the question then was, when I get the money booked to my account, where does the bank get the money from? Is it from deposits, customer deposits, as the financial intermediation theory claims? Or is it from excess reserves at the central bank, as the fractional reserve theory says? Because without excess reserves, you can't do the new lending. Or is it just, created out of nothing, out of thin air, invented? And well, the conclusion was the money was invented. The deposits didn't change. The reserves, they didn't even check how much do we have in reserves, and was untouched. And it was simply newly credited to me. Now, if you look at the legal side, for those who are interested in this question, from the legal perspective, it's actually it's most clear. It's clearly visible what's going on, because what the bank really does is when you get a loan, a mortgage, whatever, the moment you sign the loan contract, that can be considered, and the bank does consider it, as a promissory note that you've written. In other words, it's security. It's an IOU that you've issued as the borrower.
Of course. And
you promise, it's a promise to pay you to repay this money. So really, you've issued a security, like when the government issues treasuries. You've issued your loan, your mortgage treasury, your security. Okay. The bank now says, okay, we're going to buy that. And it puts it on its balance sheet as an asset, because now they have a claim on you because you promised to repay this money. And you say at this point, oh, actually, I don't care about these details, just give me the money. And if the banker is careful, the banker will say, you will find it in your account with us. They
Mm-hmm.
may carelessly say, oh, we've transferred it to your account. That would be technically wrong because no transfer takes place. That's what I confirmed in that empirical experiment, that when I got the money, it was not transferred from any other account. I mean, you know, you can see where does it come from? And it didn't come from any other account inside the bank or outside the bank. So what is it? Well, at law, because the bank has got you a promissory note, it also, according to the loan contract, of course, owes you money as well, right? That's the money that you want in the first place. That's why you went to the bank for the loan. Now, that means there is an accounts payable liability that the bank has, because, you know, it hasn't paid you, but it needs to pay you. And therefore, on its liability side of the balance sheet, it will also record the same amount that it's already recorded as an asset when it bought your IOU, say $200,000, but they also owe you $200,000, an accounts payable liability. And now is the little trick. They will book this as a liability on their balance sheet, but of a different category. They won't actually say, oh, it's an accounts payable liability arising from the loan contract. That's really the truth.
Well, it puts it in plain English.
Yes, exactly. It puts it in plain English. This other paper is called How do banks create money and why can other firms not do the same? You can also Google it. It's open access as well. And so what they do is they don't book it as an accounts payable liability, which would be correct. They book it as a liability of another type, namely a customer claim on the bank that they call a bank deposit. Because what is a bank deposit? It's a claim by customers on the bank. And this is in English law well established for centuries, that there is no such thing as a bank deposit. That's not a legal concept. It doesn't exist. All there is a loan we've given to the bank. So deposits are actually loans that we've given to the bank. And that's what they put in on their liabilities. Well, we owe them money. That's how we record it. Now, the bank's record of the bank's debt to the public, that's what we call bank deposits. And that's our money supply. And so, of course, they can invent it out of nothing. And so then suddenly, when you look at the legal side, it's not so magical or surprising that, of course, they can create money, because really they're just adding more liabilities they have. And because the banking license gives them the right to put things on their balance sheet, accept deposits, the banking license is really the license to accept deposits, that means they can invent new liabilities on themselves, which they do when they give out a loan. Now, of course, the borrower has no idea about these details, right? And they think, well, I've got money here because, look, I've got it in my bank account, current account, it's there, and I've transferred to somebody else. And nobody realizes that that's just been newly invented by the bank on the back of the bank purchasing your IOU. And as banks do more of that, the money supply expands. And this is where actually now we're at the core question, because now I come back to Japan and the capital flows and everything. So if banks lend money, they create new money, they expand the money supply. And the key question now is, what is this money going to be used for? And this has a massive impact on everything in the system. If banks were just financial intermediaries, it wouldn't really matter that much. And it's true for real non-bank financial intermediaries, whether they're insurance companies or asset management companies. It's money in here, money out there. That's just shifting existing money. That doesn't have a macro impact. But we're talking about money creators, and the central bank only creates 3% of the money supply. It's the banks that create 97% of the money supply. So therefore, their decision of who gets the money and how much money they get and what are they going to use the money for, that reshapes the economic landscape in a very short time period. Now, the simplest way to analyze this is essentially there's three scenarios. If a bank creates new money and it's used for asset purchases, then what happens? If the bank was a financial intermediary, nothing much would happen, because the money's pulled out somewhere else and it's shifted into assets. It's a shift. But when a bank prints new money, because that's what it is, like money printing, bank credit creation, bank lending, and the asset purchase takes place with, bank lending being the source of funds, then you have created new money injecting this new money into the real estate market, for example, you're going to push up real estate prices, and the same with asset prices. So when banks lend for asset purchases, you're pushing up asset prices. That explains the 1980s asset bubble. This is always unsustainable, always.
Well, it seems like, though, at least if you look at the American experience, it seems as if this process has been going on for a very, very long time.
Very true.
Exactly. I mean, we've had interest rates declining for more than 40 years at
That's
this
right.
point. And
That's right.
if you look at the long-term trends in the asset markets, clearly there have been a few bumps along the way, but it has been a very steady rise basically since interest rates peaked in 1981. So,
absolutely.
but that's what I really want to get to is,
yes,
where do the parallels come about with
yes,
the United States?
exactly,
and what's happening right now?
Exactly. And you're right. It's been quite an amazing long asset bubble in the US. There was a bit of a blip 2008, 2009, but the US was the first to recover, and it's for the same reasons. And so so we need to answer that question. So let me just outline the other two scenarios. So one is when banks lend for asset purchases, and that creates asset inflation, and that can go on for many, many years. As long, essentially, it's a big Ponzi scheme. You know, it will continue as long as banks continue to create credit for asset purchases. That's the condition. The moment that stops, it's like this, children's game where you go around the room and you've got the chairs there, musical chairs, right? And while the music is on, they walk around, but you've taken away one or two chairs. They have to sit down when the music stops, and there aren't enough chairs. And it's exactly that. So, and bankers have used this metaphor essentially, when, who was it? One
Chuck
of the big,
Prince.
Chuck Prince said, the
written,
music is playing, we're still dancing,
Right.
The music is there, they're creating credit. We have to play the game, and it's rational, therefore, for everyone to stay in the game because you're earning money. But you also have to be aware, the moment the music stops, it's going to be a rush for the door because there aren't enough seats, because asset prices will not rise anymore. And the latecomers, they're bought very expensively, and they need further capital gains just to, service and repay the loans. They won't get them. They will go bust. You have non-performing assets. And that then leads to this downward spiral where the banks then restrict lending further, which pushes down asset prices further, which creates more bankruptcies, more non-performing loans. This is, of course, what happened in Japan, but it's also what happened in many other countries. In Europe, we had the same situation in Ireland, Portugal, Spain, and Greece, for instance, in the 2000s. So the second one is when banks create credit for consumption. Now, that's the one that most people think of. Money creation, money printing, inflation. Turns out that's only one of three fundamental scenarios. And, when we had the so-called Great Moderation in the US, there was a massive expansion in the money supply, but there was no inflation. There was no consumer price inflation. Why? Well, it was money creation, bank credit creation for asset purchases. It was the asset bubble. It wasn't really a moderation. It's just, that's where you had your inflation, asset inflation. But it is true that when banks create credit for consumption, you will get consumer price inflation. That's something we need to talk about because 2020, 2021, this is, the mechanism is now in place for that to become quite prominent. Thirdly, though, there's a third scenario, and this is really the redeeming feature of the banking system. And it is why the US economy really, if you look back for 200 years, has been one of the strongest economies in the world, and why other countries that have also been very successful in the last 200 years, like Germany, and then the last 100 years, Japan, last 50 years, China, they've done the same, namely the following. You ensure that the majority of your bank credit, your money creation in the banking system, bank credit creation, is used not for asset purchases, is used not for consumption, but is used for business investment. That's the golden rule of banking. If you ensure that most of bank credit creation, money creation, is used for business investment in productive investments that expand productivity, implement new technologies, increase goods and services, create new products that have value. Of course, there will always be failures, but overall, it's of a different kind from asset purchases, property and finance, or consumption, So as long as that's the majority of your money creation is actually for business investment. And of course, the biggest employer in all these countries, also the US, are small firms. Small firms are the most important employer. It's around 70% of employment in the US, in the UK, and Japan, and Germany. Germany and Japan, actually, it's close to 80% even. Now, these small firms, they're always credit rationed and they need bank loans. They can't use, the stock market and so on. So they need bank lending. And if you have bank lending for productive purposes, ideally to small firms, you will get economic growth and no inflation. And that's quite an extraordinary insight, because we can have very high growth and no inflation. There's almost no limit to economic growth. Hang on, some people will say, hang on, aren't there limits to growth? Didn't the Club of Rome tell us, climate change and all that, we've got limits to growth? Well, not really, actually. There's a lot of misunderstandings. Clearly, we should all be careful to treat the environment well, and things like pollution and environmental degradation is bad. But growth as such is not the enemy. Because what is growth? Growth can't be the enemy, because growth is an accounting fiction. It's just an accounting fiction. There is no economic growth. Ask a physicist, tell me, what's economic growth? How is the economy growing? The physicist will tell you, no, there's no growth. We know that. The laws of thermodynamics, it's all the same. You're just transforming energy from one state to another, but there's no growth. That can't be growth. So we've created this accounting fiction by taking out certain statistical series, putting them together. We call it GDP, the national income accounts. And that's what we're monitoring. But GDP as such is not hurting the environment. It's not, it is bad activities that can hurt the environment. We should avoid those. That's fine. But it doesn't mean we have to have zero growth or negative growth. So we can have actually very high growth. The US has shown that in the past, when it was an emerging market and was growing at a very high economic growth rates. China has shown this for 40 years, double-digit economic growth is possible. And they did it by making sure bank credit was guided essentially mainly for productive business investment. They stepped in, they said no bank credit for asset purchases and no bank credit for consumption. Of course, recently, the last 10 years, they've liberalized that, but that's how you get very high growth.
Well, but if you look back at the decade leading up to the financial crisis, the banks in the United States were lending for the purpose of buying assets. Productivity has declined during that period. If you look at the last 12 years, some of the slowest GDP growth, and banks have been lending effectively to financialize. We haven't been investing. We haven't been growing the economy. We've been going the opposite direction of China. And we've seen this play out in productivity figures in the United States. I mean, this really does bring China into focus, because even though you look at the two countries and you see these very high debt to GDP ratios, one of the debts has been created for naught, and another one has built a lot of things, created a lot of investments, created a lot of future growth. So you're drawing me back again and again to what are the consequences for the United States having two entire economic cycles that were non-productive in terms of the credit creation? What happens? Yes. Where do we go?
Exactly. That you've identified the problem. It is a problem not just for the US. The UK is similar, and the UK government, they put out every year or so big reports about how the problem is such low productivity. Why is UK productivity declining and so on? And they can't figure it out. But it's exactly the mechanism that you've mentioned. And well, should we answer the question by looking at a country that still has very high productivity, despite for years people saying, oh, productivity will go down, and that's Germany. And let's look at small firms, because they're the biggest employer. Now, there is a category of small firms that are very, very successful. They're so successful that they essentially dominate the world market in their market niche. Of course, it would be a very specialized market niche, but they're like number one in market share in the world, or number two or number three. Taking this from the Olympics. So gold, silver, bronze. So we've got the champions. And people have done research on this, and they call them the hidden champions. This is when a small or medium-sized enterprise, using the international classification of size, either by capital or staff or turnover, they are small. And because they're small, nobody knows them. Like, they're not brand names. They're not BMW or, Siemens or Toyota, that type. It's just people won't have heard of these names, and they're also very specialized. So they're called hidden champions. And that's the definition. If a small firm is global market leader in place 1, 2, or 3, these top 3 places in terms of market share in the world, in their market niche, then they're a hidden champion. And they have to be SMEs, of course. We're not talking about big companies. So they meet the SME, small, medium-sized enterprise definition. Now, then you look at the world, and people have done this research. Which country has the largest number of hidden champions? And turns out to be Germany by a wide distance. Number 2 is the US. The US has 320, apparently, hidden champions, small firms that are world leaders in their market niche, but are small. That's 320. That's pretty good. It's number 2 in the world. Number 1 is Germany with 1,500. So, and the other countries are sort of 30, 40, 50 max. Even China, they have much smaller numbers. So why is this? How is this possible? And Germany has as many exports as China. It's just slightly below China, which is why China is number 1, but it's almost the same absolute amount. Of course, the Chinese population is 30 times as large. So per capita, Germany is way out exporting China even. And almost half of these exports are these small firms. How is that possible? How on earth is it possible? Well, it has to do with money and finance and productivity, because clearly to be top 1, 2, 3 market share player, you're going to be very productive. You have to be extremely competitive. And you can only do this if you have implemented the latest technology. Now, technology is something that is there. These small firms don't develop the technology, researchers develop the technology. There's universities, there's international research, doesn't even have to be in Germany. Information is available nowadays more than ever before. But why do these small firms manage to implement the latest technology? And therefore, they're so productive and they can beat the competitors. Well, what do you need to do that? You need money. And who gives money to small firms?
Small banks.
Not big banks, because
Right.
Big banks want to do big deals with big customers. I did a study with one of my PhD students. It's now published actually in one of the top finance journals, a Journal of International Money and Finance, JIMF. We looked at US data, because the US has the largest number of banks and has many small banks, also very large banks. And the simple question was, how does the size of the bank affect their lending? And the simple answer we found was, well, what do you expect? The big banks do big deals. Who lends to small firms? It's the small banks that have a higher propensity to lend to small firms, which is, of course, common sense, but it had to be demonstrated. So Germany has 1,500 small local community banks out of its total 1,800 banks. So 80% of all German banks are small local community banks. Actually, most of them not for profit even. They're either local public savings banks or cooperative banks, stakeholder banks. But they're very professionally run, and they have one rule: they only lend to companies in their footprint area, which is usually quite a small area. They will not lend outside if there's no link to their geographical area. And that's good for them because each has their own turf. They know their customers really well, and they know they're in the same boat with their customers. If the firms in their local area go down, well, that's bad for the bank, as you can imagine. They make sure that these local firms become champions in their market share, and they give them the funding to implement the latest technology. And that's what we need. And that's what, of course, all small firms need in the whole world. And the small firms are the biggest employer, more than 2/3 of employment in all countries. So what we need, therefore, is small banks. And then you get high growth. Now in the US, and so back to your question about this financialization, the number of banks has been declining.
If I could interrupt for a minute,
Absolutely.
Everything you've described is the United States is going in the opposite way. We've got oligopolies. This is back to the robber baron era. We've got small banks dissolving. We have policy post-pandemic that really has, taken small businesses to the slaughterhouse. We're doing absolutely the opposite of everything you're describing.
Yeah, yeah. Unfortunately, exactly. And that is the answer to your question, namely this increased trend of financialization, asset bubbles, essentially, instead of productive investment. So then the international productivity of US companies goes down. They need to upgrade, particularly the small firms. They need money to fund implementation of the latest technologies, and they can't get the money. That's the same in the UK. We have 5 big banks dominating in the UK. It's very extreme here in England, and the small firms don't get the funding. In the US, there still are small banks, but it's a historic thing. I mean, there used to be many, many more. There used to be over 30,000 banks in the US. Now we only have 5,000 and declining. Over the last 25 years, over 5,000 banks have disappeared. It's similar to the Eurozone. The ECB has taken very similar policies. Since the European Central Bank has been created, this is only 20 years, 21 years or so, 4,800 banks have disappeared. So what we see is that the central banks have taken policies in many countries, and the Fed and the ECB are particularly blatant in this, that kill small banks, that encourage bank mergers. The ECB is very open about it. It certainly is not a conspiracy, because the ECB has said loudly and on the record, we have too many banks in the Eurozone, and Europe is overbanked. We need to get rid of banks. What we found in this US study is that as small banks over time merge and get larger, we had a 20-year time period, already then you notice the problem that even the small banks that used to help the small firms, as they get bigger, they also lend to bigger companies. That means that even under normal circumstances, we constantly need to create new small banks, really. But what the central banks have been doing is the opposite. They've been actually actively reducing the number of banks, and therefore making all the banks bigger, fewer bigger banks.
And too big to fail.
And that's so extraordinary, isn't it? Because in 2008, there was a lot of discussion about this. And it was the big topic. It was clear that it's not good to have a small number of too big to fail banks, and it's not good for regulators. It's not good for financial stability. And we should all avoid it. And everyone was agreeing, and there's no disagreement. Yet, all the policies taken since by the big policy makers, which is the Basel Committee on Banking, bank regulation, and the central banks, the bank regulators, the governments in Europe, Brussels law for banking, all that essentially had the effect of making life hard and impossible for small banks, and was forcing banks to merge. So they introduced massive overregulation that for the big banks meant they have to hire now another 1,000 compliance officers. But a small bank with 20 staff, they can't afford to have 2 people now being compliance officer and just writing reports all day to the regulators.
Right.
In the US, fortunately, actually, there's a redeeming feature. People have been smarter than in Europe about this, because the small banks don't have to meet the Basel requirements.
But that's fairly recent that they let them out of some of the more onerous regulations. But the damage has been done, because some of these small banks made loans outside of their footprint, to use your term, and they've got huge amounts of commercial real estate concentration on their balance sheets that are not appropriate for the size of bank they are. So you have a situation in the making that you're actually going to lose more small banks in this next downturn.
Yes, yes. And in Europe, the rule has always been that they all had to meet, even the smallest bank had to meet all the complicated Basel III, before Basel II regulations. And it had meant that the smaller ones had to merge with the bigger ones, and banking was becoming more concentrated. And so that's been the problem. And as a result, of course, that means the small firms don't get the funding, don't get the local bank anymore to back them. And that means they can't upgrade to the latest technology. That means productivity goes down. That's what it means. And that means your real economic growth potential also goes down. If you then want to stimulate the economy, you will just push it into asset markets. You get also inflation, which of course, with the various measures since last year under the COVID heading, is unfortunately going to happen. So these are all the wrong developments, when the simple fact is we can have high, stable, sustainable economic growth. 3%, 4%, 5% for the US is absolutely possible without inflation, without crises, and actually without too much inequality. Because the other advantage of having a decentralized banking system with many, many small banks is that essentially your inequality is not going to be so bad. But the more the banking system gets concentrated, the more inequality you get. And we see this in the UK with 5 big banks dominating City of London and, you know, London city jobs in the financial sector. Of course, the pay is way above the rest of the country. And inequality rises, of course, with the asset price bubble as well, making those much richer, much faster, who have the means to invest in assets and so on. So all these problems actually go back to the structure of the banking system. And as you say, unfortunately, at the moment, in many countries, we're on the wrong train, where we're reducing the number of banks. And so where's this heading? And this is really scary if you think about this, because this trend is now only accelerating. And since 2020, all these government measures and restrictions, on almost every count, it has accelerated this trend. And there are further threats now coming up, because the central planners at the central banks are now coming out more openly, and they're saying, oh, actually, we're bank regulators, we're the umpire in the game, but actually now we want to play, we want to kick the ball ourselves, and why? Well, we want to compete with the banks. They want to make this less obvious, but this is really what it is. So they use a slightly geeky explanation for this. They call it CBDC, Central Bank Digital Currency.
Mm-hmm.
What is it? It's just a current account at the central bank for everyone. So suddenly the central banks are saying, we want to be bankers to the public. Now, there has been essentially an implicit agreement between the central banks and the banks that goes back several centuries in most countries. Of course, the US Federal Reserve is only 100 years old and a bit. But in other countries where they're older, like England, this is like a 300-year-old agreement. Namely, of course, the central banks are powerful because they're the banker of the banks. And they, as regulators, obviously, they can also shut down banks and so on. So they have this power. But in exchange, the agreement was the banks are the ones that deal with the public, and the central banks don't deal with the public. And also, as we saw, as I explained in the beginning, the banks are the ones that create the money supply, which gives us economic growth. But now we have on the horizon now this proposal that the central banks want to compete with banks by offering current accounts to the public. And you can imagine what happens next. In fact, the Federal Reserve Bank of Philadelphia put out a study. It's the only one of the central bank studies that wasn't full of excitement, like the others are all hailing this as the latest great development. They were cautioning and were saying, well, hang on, this is likely to drive banks out of business, because all the deposits, particularly if there's a bit of a crisis or some shock, will quickly move to the central bank digital currency, which is then going to be considered the safest bank deposit, and the banks will be out of business. And of course, add that to the trend we've already seen, that there's more regulation on the banks. And of course, finally, we haven't mentioned it. Well, you've mentioned interest rates, this policy of lower and lower and lower interest rates, and also having a flat yield curve. And in Europe, even crazy policy of negative interest rates, both on the short and the long end for countries like Germany is absolutely crazy. How does that affect the banks, particularly the small banks? Well, especially the banks that do traditional banking, lending to companies. They need a positive, or if possible, steep yield curve. because they, they can then lend at that higher long-term interest rate to their customers. And that's their margin. That's how they earn money. But this traditional lending to the real economy has been driven out of business by the central bankers flattening the yield curve or inverting it and pushing it down to zero or even negative territory. You can't earn money. What is left is what the big banks have been doing since 2008. They just borrow money cheaply from the central bank and put it into assets, asset markets, various forms of financial products and so on. But and you can earn money on that, sure. But that's not traditional banking, and it's not helping the real economy. It's not generating jobs like small bank lending to small firms does. So this is all, the train is going, as you say, is going in the wrong direction, but it's getting worse because they're adding further momentum with the central bank digital currency. And so ultimately, if the number of banks keeps going down in the US, in the Eurozone, the way it has been going down and now likely will accelerate with the next crisis around the corner. And then, of course, they will not rescue the small banks. In Europe, they've got the new bail-in policies, which essentially says, oh, the big banks, they're special. We're going to rescue those. All the other banks, the majority of thousands of small banks, oh, it's too bad, and depositors even above the payoff amount, they will lose their money. This is what they're going to do.
Richard, what you're describing, though, and I think the reason that there is pushback for a central bank digital currency, especially in the United States, is because of the power of so many of our largest banks and the pushback. But we have to remember that Janet Yellen is a labor economist by training. And I could see her very easily with unemployment possibly staying stubbornly high. She speaks often of economic scarring, the permanent joblessness situation. So I could see her advocating for a helicopter money, to use a layman's term, type of solution. You get that by delivering money directly to the people with the exact mechanism that you were describing. But there's also a byproduct, if I'm not mistaken, and that's something that is a furious debate right now. And it sounds like you're going there. Do you think this would cause inflation?
Yes, yeah. I mean, I said this already in April last year. The measures they have been adopting, the central banks have been adopting last year since March, are of a very different kind to the measures that were adopted in 2008, 2009. They're very different. Then in 2008, 2009, I was not expecting inflation. Some people were saying this is inflationary, QE, and I was pointing out it's not inflationary, it's also not going to weaken the dollar. But since 2020, the policies are very different, and they are inflationary. They're also potentially going to weaken the dollar further. I was already negative on the dollar last year, and this could go further. So that's definitely on the horizon. Now, could I just, before we go into this, because that is a very interesting and important discussion, just quickly finish off the previous discussion about the number of banks. I just want to add one more example, because you mentioned China and how this is, it's always a good comparison. Well, because of course the trend, as you reduce the number of banks and as central banks, offer digital currencies, the number of banks will go down rapidly. And then potentially when there's a crisis, then we will be left with really only the central bank. That seems to be where the ECB wants to be heading, the only bank in town. Well, this sort of system did exist before, where there's only one bank for a fairly large economy, namely the Soviet Union. That is the Soviet system. The Soviet Union had one bank, Gosbank, and it didn't really work very well. It wasn't a good system. Now, China, under Mao and the earlier leaders, China followed the Soviet model. But then in 1978, Deng Xiaoping became the new leader, and he was a pragmatist famously, and he was also an empirical guy, what works empirically, I'm interested in that, and we want results, we want to deliver. And he looked, the Soviet Union concluded, this is really not working very well. I'm not very impressed with this. He looked at Japan, and he saw, and in fact, he traveled to Japan and literally spoke to people, okay, what's your secret? And he found out, oh, it is having many, many small banks and making sure through credit guidance that it's used for productive purposes, business investment. Well, okay, we'll do that. Thank you. And that's what he did. Said and done. They copied the window guidance, credit guidance policies from Japan that the central bank was running. It's, in fact, the People's Bank of China is the only central bank left in the world that will admit officially that it's still using credit guidance. All the others, they're sort of hush-hush about it and they pretend they're not doing this. So what did he do when he came back from Japan? He created banks. He established banks, credit unions, community banks, credit associations, regional banks, provincial banks, long-term investment banks, specialized banks, development banks, thousands and thousands of banks. China now has just a bit less than America, but over 4,000 banks in China. And of course, the rest is history. The small banks lending to small firms, that creates economic growth, double-digit economic growth for 4 decades, lifting more people out of poverty than anywhere before in history. That's pretty amazing. And it goes back to the banking system. So now what are we doing? Instead of learning the lessons from history, it seems we want to be introducing the Soviet system. And it's, if you think it through, it really doesn't make any sense. We need to make sure banking systems stay diverse, and we get lots of small banks, and we need the right regulatory environment. We need the right monetary policy to encourage and allow that. So current policy with these 0 and negative rates, they're very, very unhelpful. In fact, can we quickly talk about interest rates, and then inflation will be clearer, the inflation picture. I mentioned it earlier when we talked about Japan, when Japan lowered interest rates for the first time in 91. So everyone was bullish on Japan because that's the standard thinking. If you have lower rates, it's good for the economy, good for stock markets. And so, well, they've been lowering rates for so long. Isn't it a good thing? Isn't that a good thing? Well, what's the empirical record? This story that lowering rates boosts the economy and is, in other words, there's a negative correlation between interest rates and growth. Lower rates, higher growth, higher rates, lower growth. So negative correlation and the causation running from interest rates to growth, right? That's the claim. This has been repeated, particularly by central bankers, by the journalists writing it up, by the economists and all their theories, so many hundreds and thousands of times in the last 50 years that, of course, we all assume, well, of course, that's a fact of life, isn't it? Have you actually seen any empirical studies that demonstrate this? There aren't many. In fact, mine is the first. It's published 2018. It's called Reconsidering Monetary Policy. You can also Google it. It's also open access. Reconsidering Monetary Policy, my name, in the journal Ecological Economics. Many journals didn't like this at all because
I thought it was fabulous.
There's so many schools of thought in economics. There's the classical economists like David Ricardo, Adam Smith. Then there's the neoclassical economists like Alfred Marshall. Then we have the Keynesian economists like Keynes and his followers in the post-war era, Tobin and people like that. Then we had the monetarists, Milton Friedman. We have all sorts of schools, even alternative schools. There's the Austrian school. There's the post-Keynesian school, and of course the present day supply-siders and real business cycle economists. Okay, new classical economics. Okay, now there's all these, famously, economists have all different ideas, but they all these schools, including the alternative like Austrian and post-Keynesian, they all agree on one thing, namely what we just mentioned, that if you lower rates, this will increase investment, increase economic growth. It's good for the stock market, good for the economy if you lower rates. But if you raise rates, it's the opposite. So the inverse correlation between interest rates and growth and causation from interest rates to growth. They all agree on this. So this is the foundation of modern economics in the last 250 years, let's say. But has it ever been empirically tested? No. Can you believe this? So it's like my first test in the 5,000-year history of banking. I thought, okay, let's test this empirically. And we took the data on the top economies, so the US, Japan, Germany, and the UK. It has to be a longer time period, so half a century, second half of the 20th century. And we just look at the facts: long interest rates, short interest rates, and GDP growth. what we find is that there is no evidence for an inverse negative correlation. There's a very, very strong, overwhelming evidence on all counts, essentially, of a positive correlation. Interest rates and economic growth are positively correlated. Now, what about the timing? You've got Granger causality in these tests of what happens first. Well, it is economic growth that happens first and interest rates follow. So the truth is the opposite of the official economic story in two dimensions. It's not lower rates lead to higher growth. It's higher growth leads to higher rates. Lower growth leads to lower rates. We have a positive correlation, and the causation runs from economic growth to interest rates. And that, of course, in one go blows out of the water all claims by central banks about their interest rate policy and the need for their interest rate policy, the need for lower rates. Why do they have lower rates? Well, because they've crushed the economy. Because, Danielle, the financialization you mentioned earlier, going on for a long time in the US, that means the real economy has not delivered much growth. Economic growth in the real economy has been suppressed in most industrialized countries in the last 20, 30 years. And that means that we have lower rates. So we need to push up economic growth, then we can also have higher rates. Rates always follow growth. Why do we have negative rates in Europe? Because they've got negative growth in many European countries thanks to ECB policy. Okay, so that raises a number of questions, namely, why do central banks then still talk about interest rates? The short answer is they want to confuse you. It's a smokescreen, distract attention from their real policies. It's also an alibi. Oh, we're trying to help. Look, we're working really hard. We've just lowered rates again. We're really trying to help the economy. When actually, of course, they know jolly well that rates follow growth and the economy's just gone down, and that's why they're lowering rates, following the economy. But the other question then is, what really drives economic growth? It's not interest rates, because that follows growth. It's, of course, what we discussed at the outset, money creation. It's the quantity of credit creation in the banking system. And
but for productive measures.
Exactly. And of course, central banks have control over that. They don't really need to use interest rates for that. They can talk to the banks, the big banks, and they do. And there's other ways of incentivizing banks that are not so visible to encourage them to increase lending sometimes or reduce lending when needed. And that's what's driving the economy. And of course, central banks are very much aware of the quantity of bank credit creation and their own credit creation. And that's what's driving the economy. Now, therefore, they have no excuse, as we now turn to this very sad chapter. Now they're adding inflation to our economic woes, and they have no excuses because they know if you increase credit creation for consumptive purposes, for consumption, you're going to get inflation. And this, unfortunately, is increasingly happening with these post-COVID measures. In 2008, lots of central banks were also aggressive and expanded and called it QE. By the way, I don't know whether you're aware, but that's QE, quantitative easing, actually something I proposed in 1995 in Tokyo.
Yes, you coined the term.
Yes, and it had a very specific definition. Because first I'd been forecasting this banking crash in Japan and the long recession, but then I also designed policies to get out of this. So I realized the best way to get out of this post-bank credit created asset bubble banking crisis, where the banking system is down on its knees, burdened with huge bad debts, is a new policy. You need the central bank to come in with a set of policies, and you can very quickly move out of there, which has been done in some countries, not in Japan, unfortunately. They didn't listen to me. Number one, you can get rid of the bad debts in the banking system. Really, the central banker should take some responsibility because they should have stopped bank credit creation for asset purchases in its tracks when it happens and gets out of hand. And therefore, the moral hazard principle, those who mess up should pay up. Well, so the central bank should really pay up. And that's also the solution. The central bank can just move the bad debts from the balance sheets of the banks onto its own balance sheet by purchasing.
That's precisely what happened with Maiden Lane and
exactly,
with the United States.
Lane and so on. Exactly. So the central bank can purchase the non-performing assets at obviously prices that are above market value. Well, they claim we don't know what market value is, so whatever can be face value. the central bank has no cost. And this actually doesn't create inflation either. That's what I recommended for Japan. That's my QE, the original QE. Now, in the 90s, Ben Bernanke was part of these debates we had. The central bank needs to step in, create money to purchase assets from banks, the non-performing assets from banks. That's the central bank money creation. That's how it should be done. Then, of course, you want to encourage the banks to lend again. You do this through this measure by cleaning up the balance sheets. The central bank can directly also try to create money by purchasing assets from non-banks. Fine. But more importantly, get the banks to lend again, because it's all bank credit creation that delivers growth. And one more measure I proposed in Japan, I call this, it's part of QE, I call this enhanced debt management. The government can kickstart bank credit creation. And they should have done this in Japan, they should have done it in Spain and in the UK, by simply stopping the issuance of government bonds. Well, hang on, how do they fund their deficit spending or their huge, deficit overhang? How do they fund it? Well, by borrowing from banks through loan contracts, which are not tradable, don't have to be mark to market, and therefore expanding bank credit creation in a very smart way. And they should have done this in the European, sovereign debt crisis, where you had this doom link between banks and sovereign markets. And essentially, the government should have stopped issuing bonds. Imagine what that does to the bond market. Suddenly, wow, the bond market is really strong, no more supply. So it's very good for the bond market, clearly. If you don't push any more supply out there by issuing new bonds, you stop issuing bonds. And instead, the government borrows from banks through loan contracts, which gives business to banks. The banks need business. They need to boost their balance sheets again. That means there's money creation now, because bonds issued by the government that are not purchased by the banking system don't create money. And in many countries, actually, pension funds, asset management companies are big bond buyers. That's not money creation, so it's not helping in a downturn. But by borrowing from banks, you're directly creating money for GDP transactions, for transactions that will boost your nominal GDP, you increase tax revenues. So that was the third part of this QE I proposed. Now, Ben Bernanke seemed to have listened. He was the only central banker when the 2008 crisis came. And suddenly they wanted my QE. They all said, we're going to do QE. But he was the only one who implemented at least this first crucial step of getting rid of the non-performing assets in the banking system. Unfortunately, obviously, with the bias, okay, we help the big guys, predictable, that should have been avoided. You help everyone in a fair, transparent manner, help also the small banks. Turns out the small banks actually weren't in trouble because they were not engaged in, mostly they were not engaged in the, the blow up transactions, the subprime mortgages, and the sliced and diced, credit strategies, investments. But he did it, and that's why the US economy recovered first and fastest and strongest after the 2008 crisis, if you compare to other countries, because the ECB, Bank of England, all the other countries, and also even Japan, they didn't do this. Japan then by 2013 woke up to this. I went to Tokyo to meet Mr. Kuroda, who I'd met already in around, when was it? When he was still at the Ministry of Finance. And I told him, look, this is what you should do. You should stop the issuance of government bonds and borrow from the banks. That's proper QE. And so, but I saw him again when he was central bank governor. And it seems he listened, because they have, perhaps not quite as aggressively as they could have done it, but they have increased bank credit creation in Japan as well, but much later. 2013 essentially is when they did that. I mean, after 20 years of recession, quite unnecessary recession. So, but the policies last year, 2020, and potentially also this year, are of a different kind, because then we had no inflationary pressure, because when the central bank even purchases non-performing assets from banks, that doesn't create any money. Money is created when the banking system, including the central bank, creates money and injects it into the non-banking sector, right? Then we have money creation. Then it depends what is it used for, assets or consumption. But when the central bank inside the banking system cleans up the bank balance sheets, you're just reallocating money in the banking system. That itself doesn't create inflation, and it didn't. And the dollar also didn't rise. It didn't fall, it rose. But 2020 is different. You know, in 2008, bank credit was literally collapsing because of the interbank market freezing, because everyone was concerned about, you know, are you holding some Lehman's papers and so on?
Counterparty risk, yes, of course.
Exactly. So they all, okay, we stay out of the interbank market. It's very little known, but banking is a funny business because you need banks to cooperate for banking to work, right? We talk about, say, a transfer. Let's do a bank transfer. Of course, it's not, no money is transferred, right? The banks are just doing a booking of their liabilities to the public between them, and they need the interbank market to do this. When that freezes, you do have a problem. So bank credit was collapsing, and then when the central bank steps in, you know, in total credit creation was still shrinking initially, 2009. So there couldn't be inflation. But 2020 is so different because bank credit was really strong in January, in February. We're talking 4, 5, 6% bank credit growth. Okay, so we're not talking about a collapse in bank credit. And then these measures were introduced from March onwards, where the Federal Reserve itself created credit, but also it forced the banks to create credit. And bank credit creation then jumped on top of already growing very strongly. And that's a different situation. So that's why we have the strongest money supply expansion in, well, one of the strongest in post-war history, or perhaps in Fed history. And it's very likely that this will feed back into inflation because, of course, we have also these, you know, government guarantees. We have payments, which, you know, to some extent are necessary, but they shouldn't necessarily be paid with money creation to support people. And therefore, a much bigger chunk is going to go into consumption now. That is more than what happened in 2009, 2010, where we did not have inflation. So it's a different scenario.
Well, Richard, I think on that note, you've resolved the biggest burning question, and that is that we are indeed going to get inflation. I'd love to circle back in about a year and dive deeper into what we're going to see here in the next 12 months. But I so appreciate your time today. This was riveting. I recommend your book, and the documentary is absolutely fascinating. And I look forward to doing this again.
Thank you very much. If we're lucky in a year's time, we will still only have modest inflation. It will have ticked up. It's already now ticking up, you know. So it will still be modest. And we then can discuss comparisons with 100 years ago in Germany, Weimar Germany, because, you know, we have some time, hopefully, if we're lucky, in this run up to inflation. But I think there is, particularly if you put the political scenario together with this and the central bank digital currency and the goal to reduce the number of banks. And of course, central bank digital currency is supposed to be linked to some kind of global new monetary architecture, financial architecture. Therefore, you know, it's possible that Weimar style high inflation, even hyperinflation, could be a scenario that could be encouraged by some. And so, yeah, we probably will still be talking about inflation, I think, but let's see. Thank you very much.
Absolutely. Thank you for your time. I appreciate it.